The process of assessing and analyzing long-term investment projects such as the acquisition of new equipment, expansion, or asset replacement in order to decide whether or not they should be approved is known as investment appraisal. It focuses on assessing the expected future cash flow, including the initial outlay, annual operating cash flows, and terminal cash flows while considering tax effects, depreciations, and working capital changes. Various techniques are used, including non-discounted method like payback period and accounting rate of return, which emphasize the liquidity and accounting profit, and discounted methods such as net present value, internal rate of return, and profitability index, which consider the time value of money. Among these, NPV is the most reliable method as it measures the increase in shareholder wealth by comparing the present value of future cash inflows with the initial investment. Investment appraisal is important because it involves large capital expenditure, long-term commitment, and risk, and it helps the management make sound financial decisions that improve the profitability, liquidity, and the overall value of the firm.
Should a company replace an old machine with a new one? Today, we will walk through a capital budgeting case study to find out. First, we calculate the initial outlay, the net cash outflow at the start of the project. The new machine's total cost is 355,000, including transport, installation, and modification. We also add 30,000 for increased working capital. Then, we subtract the after-tax proceeds from selling the old machine. The old machine has a book value of 60,000 and is sold for 70,000, resulting in 10,000 gain. After tax at 24%, this gives a tax gain of 2,400. So, the total after-tax sale proceeds are 72,400. Subtract that from the total cost, and our net initial outlay is 370,400. Next, we find the annual differential cash flows. Sales increased by 250,000, operating costs decreased by 55,000, and defect costs fall by 50,000. That gives us total benefits of 355,000. From this, we subtract the increase in depreciation of 45,000 to get a taxable income of 310,000. Tax at 24% is 74,400, leaving net profit of 235,600. We add back depreciation since it's non-cash and arrive at an annual after-tax depreciation cash flow of 280,600. At the end of the project, we recover two things: the salvage value of the new machine, 70,000, and the working capital we invested, 30,000. So, the total terminal cash flow is 100,000. To summarize, we got an initial outlay at 370,400, annual cash flow 280,600, and terminal cash flow 100,000. With these figures, we can now compute the payback period, net present value to decide if this replacement is financially worthwhile.
Here's our calculation for net present value. Step 1. Discount the annual cash inflow year 1 until 3. These are equal payment, so we use the present value annuity factor. Present value annuity factor for 3 years at 9% equals to 2.5313 from the PV tables. Therefore, the present value of annuities equals to RM280600 times with 2.5313, and we got RM710282.78 cents. Step 2. Discount the salvage value year 3 single payment. We use the present value factor for a single sum in year 3. PVF for year 3 at 9% equals to 0.7722 from the PV tables. Therefore, present value of salvage equals to RM100,000 times with 0.7722, and we got RM77220. Step 3. Sum all present values and subtract the initial investment. The total PV of future cash flow equals to RM710282.78 cents plus with RM77220, and we got RM787,502.78 cents. Therefore, NPV equals to total present value of future cash flows minus with initial investment. NPV equals to 787,502.78 cents minus with 317,400, and we got RM470,102.78 cents. Therefore, the project has slightly positive NPV of 470,102.78 cents. This means it is expected to generate wealth far exceeding the cost of the investment and is finally acceptable. Next is payback period calculation. Payback period equals to initial investment divide by annual cash inflow. Payback period equals to RM317400 divide by 280600 and we got 1.13 years or approximately 1 year and 1.6 months. Therefore, the initial cost is recovered in just over 1 year. This is well below the company's maximum acceptable period of the years, indicating very low risk and excellent liquidity. Based on our analysis, NPV is positive, RM470102.78. The project significantly increased shareholder wealth. The payback period also very short, 1.13 years. The investment is recovered quickly, aligning with the company risk and liquidity policy. Therefore, JM Manufacturing BHD should purchase the new machine. Both quantitative methods strongly confirm that the investment is financially sound and strategically beneficial for the company.
So the last question is explain the tax implication if JM Manufacturing Berhad have decided to dispose of their own machines. So tax implication arise due to the gain on disposal when JM Manufacturing Berhad decided to dispose of its own machine. The selling price of the old machine is RM70,000 and the net book value is RM60,000. Since the selling price exceeds the net book value, it is recognized as a gain on disposal of 10,000. Under Malaysia tax rules, gain on disposal of fixed asset is taxable income. Moreover, this gain is subject to corporate tax at 24%. This tax payment represents a cash outflow to the JM Manufacturing and must taken into account in the capital budgeting decision.
What is SME? Small and medium enterprises, commonly known as SME, are businesses that operate on a smaller scale compared to large corporations. In Malaysia, business will be deemed as an SME if it meets either one of two specified qualifying criteria, namely sales turnover or number of full-time employees, whichever is lower. SMEs are divided into micro, small, and medium enterprises and operate across various sectors such as manufacturing, services, retail, and agriculture. The details of the classification based on size of operation are as follows. Micro-enterprises across all sectors are defined businesses with sales turnover of less than 300,000 or less than 5 full-time employees. While for manufacturing and services sectors, the detailed classification is presented in this table. One of the most common issues associated with SME is access to financing. While the findings of OECD and domestic surveys reveal increase of access to financing by SME, there are perceptions that access to financing is still an issue facing the SME. According to a study by Bank Negara Malaysia titled Access to Financing for SME, Perception and Reality, the perception that financing is a major constraint for Malaysian SME does not fully reflect the actual situation. Firstly, there is a perception that financing is a key constraint for Malaysian SME. However, survey findings show that 97% of SME that applied for financing were successful, indicating that access to financing is generally available. In fact, most SME reported that their main concerns were business-related, such as weak demand, high operating costs, and economic uncertainty, rather than difficulties in obtaining financing. Secondly, SMEs often perceive the loan application process as complicated and time-consuming. In reality, banks in Malaysia have simplified the financing application process through initiatives such as the Partner Program. The processing time for unsecured SME financing has been significantly reduced to between 7 and 16 days. Additionally, more than 20,000 bank offices nationwide have received specialized training under the Train the Trainers program to assist SME by providing guidance on financial matters.
Another common perception is that banks do not provide financing to start up. However, evidence shows that around 20% of SME financing approvals are granted to newly established businesses that have been operating for less than 3 years. This shows that financial institutions are increasingly willing to support younger SMEs. Lastly, SMEs often perceive that they will be the first to experience withdrawals of financing lines or a reduction in credit limits during economic downturns. Contrary to this belief, since the Asian financial crisis, banks have been demonstrably more willing to provide debt restructuring and rescheduling R&R assistance to viable but financially distressed SMEs, particularly during period of economic slowdown. In conclusion, while SMEs commonly perceive access to financing as a major challenge, evidence suggests that these concerns are largely due to misconception and information gaps. Financing for SMEs in Malaysia is widely available. The application process has improved and support mechanisms are in place to assess SMEs, even during difficult economic conditions.